We all want the idea of passive income, but there's always the limiting belief that it's risky, involves a lot of money, or that it'll be difficult. The goal of a stream of income that's truly passive and requires little to no maintenance is a dream for many. However, not many know how to get to it. This is Income Intelligentsia, real-life advice for practical and financial goals. What we want to talk about now is how to invest in index funds and why you should do so. There are many different reasons to do it, so let's get to it. We all want to take proper control of our money. That's why we talk about it constantly here in the channel. But more importantly, we also want to be in control of our time. But to do that, you'll need to be able to find another form of income where you're the boss and that your money is the one working for you. There are many ways to earn money. Some take more work than others, and some take no work at all. The idea that we have today is one of that is truly passive and requires you to only do upfront work at the start and you just wait it out after. The topic we want to talk about today is going to be index funds and how your money moves passively with it. One of the more beginner-friendly investments are index funds due to the little to no research required to start it. The general idea here is that you'll buy a representative of a group of stocks, and as a result, you don't have to do most of the mental heavy lifting in order to start investing. Index funds are popular with investors that are just starting out because they're cheap to start off with, easy to get into, and reliable over time. For the most part, you only need to think of buying a small piece of everything, whether it's from the S&P 500 through VFIAX, real estate from VGSLX, or even tech stocks from VGT. You'll do no wrong due to the diversified nature of index funds. For a lot of new investors, index funds are favorable due to being a passive type of stock where you can just sit back and let it accumulate value and dividends for you. The idea here is that you buy a stock and hold it long term so you can grow it throughout the years. From there, it either generates dividends that pay out regularly depending on a stock, or you'll hold it long term so its value grows. Understand, however, that the dividends you get are income taxable as opposed to growing its value over time and only being taxed once after you've sold the stock. This way, you truly don't have to do anything in order for you to earn money. The only thing you have to do here is wait and let the market do its job for you. Apart from it being automatic, it also has lower maintenance fees compared to actively managed funds, requires lower costs due to needing minimal research and preparation, and has strong and consistent returns over time. Historically, it also beats out individual investors in the long run due to their lower risk and wide coverage of the market. Because you don't have to think too much about your investments, you're also not susceptible to trading emotionally when the market favors an individual stock. The risk in putting all of your eggs in one basket only for the stock to crash immediately after is too great for new investors. As a result, you're not pressured into investing into one specific stock at a time. You also have the benefit of not having to time your investments. Because you'll want a group of companies to invest in, you'll have the advantage of spreading out your options and learning from experience. It's definitely one of the easier ones to start your investment portfolio on, given the nature of its consistency and ease of entry. If you don't have the time or the energy to research individual stocks, it's also good for you as you don't have to analyze every single stock that you buy from that group. The important thing to understand here is that you buy a piece of a lot of companies, and as a result, you're spread out. That being said, because your investments are diverse, you don't have the same astronomical returns from an individual stock that may be on the rise. It's certainly not a get-rich-quick scheme either, as it takes a lot of time for it to fully pay for itself and in return have it passively generate income for you every day. It's important to note that you need to be patient in letting it do the work for you. Because it's a passive way to invest or learn how to, it requires a lot of time for people to get their return on investment. We're not going to sugarcoat it and just say that it takes decades for people to get back what they invest. Because it replicates the market, it still carries market risks such as downturns on specific industries that you may want to invest on. Because it's not concentrated on one stock, the returns aren't as big as successful single stock investments. You're not guaranteed to get rich quick through this method, but you'll want to stick with it if you want consistency, reliability, and are able to hold on to stock for decades. It's also important to understand the role that the industry plays in the market. Perhaps you're knowledgeable in technology and you'd want to invest in VGT because you believe in their potential value. Investing in technology stocks through an index funds may not be a bad idea. You want to stick with it for consistency and general reliability, but it's not a stock that will help you get rich overnight or even over the next few years. The idea behind this is that you hold for a long time and eventually let it work its way up through compounding and accumulating growth over time. Because that's the case. It's not for investors that are willing to take a huge risk in order to invest in something that they believe will raise in value significantly in a very short amount of time. We're not saying that index funds are risky or risk-free. What we want to get across is that while it carries market risks, it lets you, a new investor, into the world of investing in a way that allows you to understand the market as a whole. Ultimately, we wanted to talk about an investment that is truly passive and is a great starting point for newer investors. The idea behind this is that you'll not only grow your portfolio, but also be more aware of the market over time. You're going to be constantly surrounded by market changes, and as a result, you'll gain a better understanding of how certain industries are assessed and valued. Much like the reliability in income, your knowledge of the market and how to work with it will also grow at a slow and steady pace. You'll gain a better appreciation for industries while also making your money just by waiting it out. If you've enjoyed this video and found us helpful, please hit that like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you on our next video. Stay mentally healthy, and let's get financially fit together.